WFSU-FM now presents a delayed broadcast of the May 24th, 2013 luncheon meeting of the Economic Club of Florida. This program was recorded at the Tallahassee-Leon County Civic Center. To introduce the featured speaker, here's Economic Club of Florida President-elect Ash Williams.
Thank you for joining us, particularly on the Friday of Memorial Day weekend. I'm delighted to introduce Bayo, who goes by Bayo Ogunlesi. He is chairman and managing partner of Global Infrastructure Partners, which goes by the acronym GIP, a private equity firm that invests in infrastructure assets in the energy, transport, and water sectors in both OECD and select emerging market countries. Prior to founding GOP, Bayo held senior positions at Credit Suisse, including executive vice chairman and chief client officer and global head of investment banking. He's a director of Callaway Golf Company. Golfers do not even think about trying to get a deal on clubs. Goldman Sachs, those of you who would like to borrow huge sums of money, talk to them. Let's see, Cosmos Energy Holdings, and non-executive chairman of the Africa Finance Corporation. He holds a BA degree with first-class honors in politics, philosophy, and economics from Oxford University, a JD, magna cum laude, from Harvard Law School, and an MBA from Harvard Business School. From 1980 to 81, he served as a law clerk to the Honorable Thurgood Marshall, Associate Justice of the United States Supreme Court. We are truly honored and privileged to have with us an investor who I think I can reasonably say is probably the leading infrastructure investor in the world, among the leading infrastructure investment firm in the world. Please join me in welcoming Bayo Ogunlesi.
Thank you, Ash, and I'm delighted to have the opportunity to speak to you this afternoon. I know I'm probably standing between many of you on the beach, so I will try and make this brief. But it's really a pleasure to have the opportunity to speak with you and talk about a little bit about infrastructure, which is obviously a subject that's near and dear to my heart. I thought I'd start by giving you a brief overview of who we are at GIP. We set up the firm it'll be 7 years ago in July. We started with seed funding from Credit Suisse and General Electric Company. It was a group of us who came out of Credit Suisse and General Electric Company. We had $1 billion from CS and GE. And we then went around the world and raised a total of $5.64 billion in our first fund. That fund is now fully invested, and we have now to date returned about $4.5 billion to our investors. Our second fund, which closed in September of last year, and we're very pleased that the State Board of Administration is one of our significant investors, raised $8.25 billion, and to date we've invested just under $1.7 billion of that. Next week I will be in Luxembourg to sign our third investment, and which will take us to about 30% in investment. Today, GIP is the largest independent fund manager of infrastructure assets. Among the 12 portfolio companies we own Gatwick Airport, which I hope some of you fly through. If you go to London, please fly to Gatwick, not Heathrow. It's the second largest airport in the UK. We just last year bought Edinburgh Airport, which is the largest airport in Scotland. We own a company called Access Midstream Partners, which is a gas gathering business. These are the companies that take the natural gas from the wells to market. It is today the largest gas gathering company by volume in North America. We own the Port of Brisbane. It's the third largest port in Australia. It's the only port in Brisbane. The nearest competition is about 500 miles away. And as I think many of you know, Brisbane is the fastest growing of the states in Australia. We own a company called Transit Gas. It's a natural gas pipeline in Switzerland that connects the three key markets of Germany, France, and Italy. So it's very, very strategic. We own Ruby, which is a pipeline out on the west. It goes from to California, which we did as a joint venture with Kinder Morgan Company. And we also own the largest container terminal in Argentina. Now, Ash suggested that there are a couple of things that I might cover in my remarks, and obviously we will have an opportunity for questions. One was to give you some sense of the scale of investment that's required in infrastructure in the US and across the globe over the next 10, 15, 20 years. Second thing you thought I might address is we've seen a lot of interest by certainly institutions such as the State Board of Administration to invest in infrastructure. Why do they want to invest in infrastructure? How do we at GIP look at making investments? How do we deploy capital? What has been the return experience for people who have invested in infrastructure? What are the reasons why some countries seem to do a better job than others of being able to attract the required investment in infrastructure? And certainly the US is one country that has not done, at least in recent times, has not done a good job as it could. What are some of the lessons learned? And what role can private sector investors such as GIP play in infrastructure investing? Well, why don't we, I'll try and talk through it as we wait for the slides to reappear. But basically, the amount is massive. The OECD, which is the Organization of Economic Cooperation and Development, did a study of the requirement. It was something like $55 trillion between now and 2030, or about 3.5% of world's GDP. McKinsey, the consulting company, did their own study, and the number they come up with was somewhere between 60 and 70 trillion dollars. So these are huge amounts of money. And of course, what's driving that is a variety of things. In emerging markets is clearly the growth of countries like China and India and Brazil. Rising standards of living around the world as people get cars, they want roads, they want to be able to fly on airplanes. Increases in world trade. And in most of the developed countries, it's really the need to replace aging infrastructure. So two things that are interesting, I think, about these statistics is one, there is a shift that we're starting to see in the geography of where this investment is being made. If you go back 10, 15 years, something like 15-20% of aggregate infrastructure investing was in emerging markets like India, China, Brazil, countries like that. Over the next 15 to 20 years, fully 50% of the investment requirement will shift from the developed markets like the US or Europe to emerging market countries. A second interesting sort of phenomenon is a difference between the types of investments we're seeing. For most emerging market countries, the investment is in new infrastructure. So China is building new airports. I think every month, China builds as much power generation capacity as is used in all of the United Kingdom. That's the scale of investment that's happening in some of these emerging market countries. In the developed market countries, the investment is really on refurbishing existing infrastructure. So you look at, in the last 2 weeks, I've been in the United Arab Emirates, I've been in Singapore, and I've been in China. And of course, when you go to all of these places, you fly back into JFK, Kennedy Airport in New York. And sometimes it's hard to remember which of these 2 countries or 3 countries or 4 countries is the emerging market country based on the quality of the airport, with JFK being sort of old and decrepit, and China and Abu Dhabi and all of these countries having much better infrastructure. So for those of you who are engineers, the American Society of Civil Engineers does an annual rating of US infrastructure. I'm afraid the grade was not good. The US as a whole got a D+ grade. Just about most of the categories we ended up with D or lower grades. The highest grade we got was in solid waste at B-. And of course, the state, you might want to ask, well, how did Florida do? Because they also rate the states. Florida is a little bit above average. Florida ended up at a C-. And of all the states that they've rated so far, the highest rated state was Hawaii, which got a whopping C+. Okay? And what's behind this? Well, what's behind it is a steady decline in the amount of investments we've been making in infrastructure. If you go back to the 50s and 60s, something like between 5 and 10% of the gross domestic product went to infrastructure investing. Today, that number is between 2 and 3%. So it's not a surprise that you read about bridges that are collapsing and roads that are sort of decrepit. The Ash and I were talking about this earlier, the air traffic control system we have in the US, even though it works, they will tell you that they're using computers that were built in the 1950s and 60s, whereas in other parts of the world, they've gone to much more sophisticated means of investing. And part of this, of course, is a function of the fact that fully 75% of infrastructure investing is really done by states and municipalities. The federal government only does something like 20, 25, 30%, and that percentage has been falling. So when you think about the challenge, as we go forward in the next 5, 10, 15, 20 years, and states, federal government, municipalities have constraints on their on public resources, and the competition for ways to spend the limited resources they have, whether it's healthcare or retirement benefits or education, are putting even greater constraints on the ability to have infrastructure. So this chart, what this chart does is gives you a sense of what the investment requirement in the U.S. is like, and how much of it is funded, and what the gap is. And just a few key numbers. I know not everybody can see these charts, but through 2020, we need to invest $2.7 trillion in infrastructure. Through 2040, the number is close to $5 trillion. And the funding gap, the amount of money that needs to be raised that nobody's sure where it's going to come from, is well over $1 trillion. If you look at individual areas, in surface transportation, roads, rails, the amount is about $850 billion. Wastewater, fully 75% of the money we need to spend on infrastructure and water and wastewater, we don't know where that's going to come from. And as I said, this problem is only going to get more acute as we go forward. In one area, the natural gas midstream sector, I think everybody has been reading about the shale gas revolution, which means today the US is actually now the largest producer of natural gas, and by 2020, we will overtake Saudi Arabia and become the largest producer of oil in the world, and hopefully sometime in the not too distant future we will be energy independent, and which has huge economic and political ramifications for the US. The requirement for investment in that sector is approaching $200 billion. But the good news is all of this money is going to be funded by the private sector. And if you think back to that chart that we showed where the US, where we had the ratings for US infrastructure, what you would find is that in most of the areas where the private sector is actively involved, the ratings are actually higher, which I think suggests some of the path forward for the US going forward. So then the next question is, well, why are people actually investing in infrastructure? This all started, unfortunately, outside of the US. Australia and Canada were the two pioneers where we had institutions, pension funds, insurance companies, foundations investing in infrastructure. And the reason for that was, when you think about Australia, Australia actually has the third largest pool of capital in the world, but it's a very small market. So the Australian institutions, there's only so many Australian equities or fixed income instruments you can buy. You can certainly invest in US companies or European companies, but if you're an Australian institution, one of the things you want to do is invest in assets that match the profile of the liabilities you have. So when you think about infrastructure assets, these are all long-term assets with very long lives, which match long-term liabilities of many of these pension funds and superannuation funds. And it coincided with a period in time where the Australian government decided they were going to privatize most of these activities. So they sold their airports, they sold their ports, they sold their road systems, electricity generation systems, and by the time they were done, Australia actually had no debt. And would that the US would be in a position similar to Australia doing something like that. So the Australian and the Canadian pension funds were the first institutions to actually actively get involved in investing in infrastructure. And more recently, we started to see a fair amount of interest on the part of US and other institutions. So the State Board, for example, as I said, has invested in GIP. CalPERS and CalSTRS, the two retirement systems, big retirement systems in California, have made public announcements that they want 5% of their portfolio to be in infrastructure. And we think that is a trend that will continue to grow. Now that sounds like a lot of money. CalPERS is a $250 billion asset company. But when you compare it to some of the Australian institutions, which have 10, 15, and higher percentages in infrastructure, you know that there is still a long way for them to go. So why are people investing in infrastructure? Well, when you look at these, what we've tried to set out on this page is one of the reasons why an investment in infrastructure fits very well into a balanced profile of investment. You think about infrastructure as sort of a hybrid between fixed income investments and equities. So it has very stable cash flow, so it generates an annual dividend. At GIP, we've paid an annual dividend of 7% to our investors in our first fund, and yet it provides some scope for growth. And what's attractive about infrastructure, if you invest in it the proper way, is that it has very low volatility. So it's not like the stock market that goes up, 25% and then, crashes sort of 50%. It is, as I said, generates current cash flow. But most importantly, the behavior of infrastructure investments are not correlated to most other asset classes. So when equities go up, they don't go up as much, or when equities fall, they don't fall. And we think that is, in fact, one of the reasons why many of these institutions are looking at infrastructure as a nice way to balance their portfolio. So why is that? Well, you look at the nature of these assets. It's because they all have long lives. Power generation plants, they last, 50, 75 years. Pipelines, they last forever. An airport, an airport is around forever. In fact, and there's very limited risk of technological obsolescence. So one of my partners who came out of General Electric Company, when we made our first investment in an airport, he said, I think I died and went to heaven. I said, well, why? He said, well, think about it, okay? We own an airport. I don't worry about somebody moving the airport to some low-cost country where they pay, wages that are a tenth of the wages they pay in the US. I don't worry about the Koreans or the Chinese violating my patents and creating sort of a competing product, because these things are really, for the most part, either natural or regulated monopolies. In most cases, the prices they set, whether they're set by regulation or by concession or by contract, allow you to raise your prices with inflation. So if you think about investing in an asset that gives you protection about inflation, that's really good. Most of the demand for these services are inelastic. So for example, whether you like it or not, we all have to drink water, we all have to use waste services. Electric generation is pretty much steady. Although if truth be told, if a recession gets to be deep enough, even infrastructure businesses are affected by economic conditions. So if you think about the US, we've now seen in the last 5 years, I think something like the 3 years of consistent decline in electricity consumption. That didn't happen even during the Great Depression. So, if circumstances are stressful enough, even these businesses are affected, but certainly that's not as bad as being in the auto industry or in the chemical industry, where in fact your demand sort of disappears. Then the final thing that's good about these businesses is that they're really very badly managed. So I'll give you some examples from some of the businesses we own. We bought an airport in London called City Airport. It's a small airport. It's probably about the same size as Tallahassee Airport. And most of the people who use it are business travelers who fly from London to Paris or Geneva or places in the continent. Now, one thing business travelers don't do is they don't check a lot of luggage. Yet when we bought the airport, we found that they were actually losing luggage. So we picked one of our guys who had spent his entire career working at factories, and we sent him to the airport. And the CEO calls me up and says, what's the matter with you people? Why are you sending a factory guy to an airport? I said, well, think about what an airport is. It's logistics. You're moving people, you're moving bags, you're moving planes. This guy will help you with your logistics. Say, well, you Americans, you're all very strange anyway. So 6 months later, the same CEO called me up and said, do you mind sending this guy on a full-time basis? Because he had shown them in the space of 6 months how he could help them improve their business. And some of it was serious, some of it was silly. So he said, look, I think I can solve the baggage problem. So I said, fine. So what did he do? It wasn't a fancy, sophisticated baggage system. All that we had were people would take the bags, they put them on carts, and then wheel them out to the planes. 5 minutes lifting bags, he called me up and said, I've solved the problem. I said, so I was thinking if he had some fancy solution. He said, no, this is what the problem is. We had 14 gates, and they had 7 carts. So they were loading bags for 2 planes onto each cart, and of course the bag that was supposed to go to Geneva would go to Paris. So he spent $10,000, you buy 7 more carts, problem solved. Another example was The guy, we have short-term, like I'm sure they have at Tallahassee Airport, they have short-term parking and they have long-term parking, right? But because this is a really small airport, the short-term parking and the long-term parking were only about sort of 50 yards apart. So he walks out there and he asks the fellow who was in charge of parking, he says, take a look at this parking and tell me what you see. And the fellow said, well, I see a lot of cars in the short-term lot and I don't see many cars in the long-term lot. He says, well, what does that tell you? He said, well, I don't know. Long cars in short-term lot, cars in short-term lot, no cars in long-term lot. He said, well, obviously what it tells me is that we are underpricing our short-term parking, right? Because, if people don't want to walk 50 yards to go park in the long-term lot, it means you're not charging them enough for the short-term parking. So we raised the prices by 40%, and of course, it didn't change behavior, and we made a lot of more money, and everybody was happy. So those are the kinds of things that you can do with these businesses, and I'll just give you some examples from some of the companies we own. So I talked about Access Midstream, right? This is the only way that our customers, Chesapeake, Total, some of these oil and gas companies, can take their gas from the well to market. So we have long-term contracts, 10, 15, 20 years. They're take-or-pay, so whether they ship the gas or not, they have to pay us. They pay us a fixed fee. Every year we get to raise the prices, every year. So that's obviously the kind of monopoly business that you would want to own. Gatwick, we own all of Gatwick. We own the land, we own the runway, we own the terminals, the parking, everything, and we control it, okay? And so what we've been able to do at Gatwick is dramatically improve the way the airport functions. When we bought that airport, they had a plan to spend $1 billion on capital, actually £1 billion, so it's about $1.5 billion on capital spending. And so we started going through all the items. And we saw one item which looked very curious. It said they were spending £50 million on what they called mood improvement. So we said, well, what is mood improvement? They said, well, we're going to change the lighting and we're going to play music in the check-in areas where people check in to get, before they go to board their planes. And we say, well, why are you doing that? Well, because people are spending a long time checking in, and we think if we improve the atmosphere when they check in, then everything will be fine. So we say, well, why don't you figure out how not to make them spend a long time checking and save yourselves £50 million, okay? So what did we do? When we bought the airports, they were processing about 120 people an hour through the security system. Those things where you have to take your coat off and everything else. Today, it's 250 people an hour using half the number of people that used to do that, okay? The reason is because we set ourselves a goal that we want to get from 150 to 180 to 200 to 250. And actually at Edinburgh, we're now doing 300 people an hour through the security systems. And it was by making some very, very little changes. For example, did you know that one of the most constraining factor in how quickly people can go through security is the size of the tray? Did you know that? I didn't know that. They told me this, right? Because unlike the US where you have to put your iPad in one tray and your coat in another tray and the toiletries in another tray, in the UK you can put everything in one tray. So we bought big trays so they could put everything in one tray because the machine can only process so many trays a minute. So if you're sending 3 trays through, then you'll be slow, right? The other thing we did was, most of the people who use Gatwick Airport are vacation travelers, right? So we set up separate lanes for families traveling with children so that the business people can go, and then we had people to help the family. So when the 3-year-old kid is running around, you don't have a bunch of business people staring at the mother and father, with daggers in their eyes, saying, you're holding me up, this kind of thing, right? And what happens when you do that? When people get through security faster or feeling less stressed, what happens? They go to the other side, and what do they find? The duty-free shop, the bookstore, the coffee shop. They're feeling good, they're about to go on vacation, they spend money, they buy things, and we make money, everybody's happy, okay? The other thing we did at Gatwick Airport is when we bought it, Gatwick was at that time, and still is actually, it only has one runway, so it's the busiest single runway airport in the world, okay? So we had some of our guys, they work in industrial companies, GE, Honeywell, places like that. They did a study, and they said, look, Gatwick today was having 55 movements. That's 50 movements. That's a takeoff and a landing an hour. They said, we think we can get to 55. And when we told the manager and say, oh no, it can't be done, we're already the busiest single runway airport in the world, people come from all over the world to study our operations. Well, actually today we're at 53. And we're figuring out how to get to 58. Now, each of those slots is worth £1 million. So by making the airport more efficient in the way they land and have planes take off, we are creating more money for ourselves. The airlines are happy because they can get their planes up in the air, and of course passengers are happy because there are much fewer delays. When you go through Tallahassee Airport, do you have any sense that anybody at TSA is worrying about how much time it takes you to go through security? Any sense of that? You see that there are probably 15 of them. 5 of them are on the phone talking to their friends, and then and the line is out to the well, because we control the airport in the UK, we can make these kinds of changes. So those are some of the kinds of changes that we've made. So how do we at GIP look at making investments? We only invest in 4 sectors, as Ash said: energy, transport, 3 sectors: energy, transport, water, and waste. The reasons we picked those sectors was not very scientific. It's because those were the backgrounds of those of us who started the fund. I used to be in the energy business, so we figured if you invest in things you know something about, good things will happen, and in fact, that has been the case. We look for large investments because what we would like to do is we want to control our own destiny. So we either want to be the sole owner or own it in conjunction with people who think like us. And most of the investment we make in developed countries. So we have the UK, we have things in Switzerland, as I mentioned. We have many things in the US, Australia. When we started GIP, we thought we would invest in emerging markets, but what we found was most of the investments in those countries tend to be really small. Most of them are situations where you actually have to build something new. And most of them are not quite, they don't quite play well with our approach of really driving the way the business is run and getting it to work better. So we have one investment in India. It was a small investment. It was $40 million. We tease the CEO of the company that every time we send people from our operating team to help him, we destroy his economic financial performance because he's got to pay the airfare, he's got to pay the hotel bill, and he can't make any money after he's paid all of those things. So we look for these kinds of assets, as you see: long-lived assets, stable cash flow, inflation protection. And then we look for things where you can actually run the businesses differently. So for example, we don't invest in toll roads. We don't invest in toll bridges, not because they're not good investments, but because when you think about it, if there's a recession or gas prices sort of go high, people stop driving. There's nothing you can do to affect the destiny of that business. We like businesses where if something happens, there are all kinds of levers you can move to allow you to increase your performance. And this chart just, I know it's very busy, but what it does is it shows you some of the tools. And those of you who've been in industrial businesses will recognize some of these things: Six Sigma, Lean, Kaizen, which are the tools that companies like GE or Honeywell or industrial companies use to manage their businesses. And we've found that when you apply them to infrastructure businesses, you can actually make them run a lot better, provide much better service for your customers, and generate superior returns. And just to give you a sense of how you can do that, I picked 2 of our portfolio companies. Channel View is a natural gas-fired power plant in Texas. It's one of the most efficient power plants in Texas. We only own 1 power plant. The company we bought this from, Reliant, owns about 50 power plants, okay? Yet in the 3 years that we've owned this business, we've reduced what they called fixed costs, which are costs that you aren't supposed to be able to change, by over 30%, okay? So the annual savings that we've been able to generate are roughly between $10 and $15 million a year from costs that are supposedly fixed. And this is in a company that makes $50 million. So you think about how much value you can create when you do that kind of thing. Or take City Airport, right? When the recession hit in 2008, which, as you would expect, since most of the people who use that airport are in the financial industry, the number of sort of movements, takeoff and landings went down by 20%. In spite of that, we've basically kept the profitability of the company at the same level, even though we lost 20% of the volume from this business. So we like businesses where you have all kinds of levers to move to improve your performance. So how have the returns been? What we've tried to put out on this page is the performance of our fund, our first fund, against the S&P 500. The top line is our first fund. The middle line is an index that UBS provides, which is called the UBS Infrastructure Index, and then the bottom line is the S&P 500. And as you can see, in every single year, the infrastructure index has actually done better than the S&P 500, and our fund has actually done better than both the S&P 500 as well as the S&P 500. So the point is, if you manage these businesses well, you can actually do very well. So what does the world look like today for infrastructure investing? Well, the good news is there's a lot of private capital available for investing. Pension funds I've mentioned, sovereign wealth funds are all looking to invest in infrastructure assets. And of course, the corollary is when you have a lot of money chasing very few assets is prices obviously go very high. So I'll give you an example. The government of Portugal, you probably can tell from this that we love owning airports. So last year, the government of Portugal announces they're going to sell all of the airports, Lisbon, every airport that Portugal owns. And so we put together a consortium to participate in it. There were only 3 groups that put in offers, ourselves and 2 others. We thought long and hard, is Portugal going to stay in the euro? Is the euro going to collapse? And we just managed to get to the value that the government had as their minimum price, which was 2 billion euros. The group one of the other groups bid 600 million euros more than we did. The winning group initially bid 3 billion euros as compared to our 2. And then they got nervous, even though they were sort of competing against themselves, and they put another 100 million euros on top of the 3 billion euros they put. So, we may be bad, but we don't think we're 50% bad. So that's the kind of thing that you're starting to see happening with some of these assets. And of course, what we're doing is any asset that we can sell, we're selling because, obviously you want to sell when people are looking to buy things. So how are we at GIP responding to that? What we're doing is we're looking for opportunities to partner with companies who have assets that have these kinds of characteristics within their portfolio. So we're working with energy companies. We're starting to work with mining companies. Because when you think about all these businesses, they all have railroads, they all have ports. The energy companies have pipelines, they have gathering systems, and there's really no reason why they have to own them. And what we think is attractive about GIP is, A, we're able to invest a lot of capital, but B, we're actually able to help them manage their businesses much better than these companies themselves were able to manage their businesses when they owned it alone. So we think that's an attractive area of opportunity for us going forward. And let me end by giving you some sense of what's happening on a regional scale. And what we try and set out on this chart, which I know is very hard to read, is how much money different parts of the world are investing in infrastructure. China is investing $500 billion a year on infrastructure, about 8% of their gross domestic product. The US, in contrast, is investing about $370 billion. Now, of course, the US is not building new airports, so there's some explanation as to why we're investing less. The US obviously has a much larger economy than China, which is of some reason why we're investing less, but I think it's clear that there is a link between economic performance and investment. And so the World Bank did a study, and what the World Bank concluded was that if India invested as much money in infrastructure as China did, India's economic growth would actually be faster than China's. Look at many of the Latin American countries. One of the reasons why many of them have had difficulty stimulating economic growth is because they have reasonably poor infrastructure. So it's clear that there is a link between infrastructure and economic growth. And then why have some countries been able to attract private investment in infrastructure, and why have some not been able to? And what we try to do that is set that out on this stage. And as you can see, the country that has the greatest number of ticks is Australia, because they have public policy that allows it. They have pension and annuity system that supports infrastructure investing. They have privatized infrastructure assets, and of course, Australia has some of the best infrastructure in the developed world. On this next page, we had KPMG did a survey with some infrastructure engineering and construction companies, and what they found was that the single most important reason that deters private investment in infrastructure is public policy. So you think about the US. Several years ago, a group of investors went to the state of Pennsylvania, offered them, I think, almost $12 billion to buy the Pennsylvania Turnpike. The governor signed off on it. It went to the legislature, and the legislature rejected it. I think that was probably not one of the more finest moments of that legislature, because I'm not sure that asset was ever worth $12 billion. They should have taken that money and run, before people change their minds. So, and when you think about the U.S., it's quite curious actually, because the most significant areas of infrastructure, energy, power plants, pipelines, things of that sort, they're in the private sector. Telecoms, it's all in the private sector. Yet roads, water, wastewater, things of that sort, which are in the public sector, there seems to be a tremendous reluctance on the part of state municipal governments, and in fact, much of the population, to engage in the privatization of these systems. All of the UK airports, they're all privately owned. Many airports in Europe are all privately owned. All Australian airports are privately owned. I was talking to Ash recently. The air traffic control system in the UK is actually controlled by the private sector. One of my partners advised the UK government in selling it to a group of private investors. So there is nothing about these assets that suggests that they need to be in government hands. And I think looking forward, what we have is a unique opportunity to get the private sector actively involved in infrastructure investment. Because when you think about it, clearly, as we've seen, the demand is great. There's a lot of private capital that's available, whether it's from domestic pension funds like the State Board of Administration, international sovereign wealth funds, international pension funds. There's a lot of debt available. The private sector is able and willing. And I think it really is a question of the political will to get some of these things done. Now, on the part of the private sector, what I think we have not done a good job of doing is convincing people that if you turn some of these services over to the private sector, what you will get is actually much better quality service. I know the mayor of New York, and every time I see him, he asks me, when are you guys going to buy LaGuardia Airport and Kennedy Airport and run it much more efficiently? I wish they would sell us LaGuardia and Kennedy airports, but that is the challenge, and I think that is the opportunity. So let me stop with that, and if anybody has questions, I'll be happy to answer them.
Thank you. Let me just remind you that the Q&A session is open for members. We have a microphone down in the front, and if you have any questions, please feel free to come down.
Bayo, how are you?
Fine,
Appreciate your comments. Picking up on Run More Efficiently for New York and LaGuardia, what happened in Australia, just trying to understand, they could have issued, the old way is to issue debt for infrastructure. And the new way is they privatized it through private owners, private financing, and you guys made more money. Do the users of that infrastructure pay more ultimately?
That's a very good question. I think there are a number of issues that people raise when they ask about private sector involvement in infrastructure. One of them is it going to cost more, right? The second one is, don't you private sector people all show up and just fire everybody, okay? And here's our experience at GIP. Of all the 13 portfolio companies we own, the only one where we've actually laid off people we've only laid off people in one. And that was a business where this is a waste company. They pick up industrial and commercial waste, they put it in landfills. Their businesses, the volume of their business after the recession in the UK were off 30%. So there was just no way you could continue to run the business with that many people. In all of our other businesses, we actually have not laid off people, because our view is the way you get improvements in the operations is not really by firing people, it's by making the business, more efficient, focusing on providing high-quality customer service, and things of that sort. And so what the Australian government decided was twofold. One, they did not want to continue to increase their stock of debt. So when they sold these assets, they actually paid down their debt. Two, the Australian government was convinced that the private sector would do a much better job of running these businesses than the government itself could do. And in fact, if you've flown through Sydney Airport or any of these airports, Perth, Melbourne, prior to privatization and post-privatization, you'd see a very marked difference in the way the airports have been run. Those of you who've flown through Gatwick Airport, before we bought Gatwick was a mess. I mean, it was really, even though it was in the private sector, it was a really badly run airport. In the 3-4 years that we've owned it, we think we've made very substantial progress in improving the quality of the airport. It used to be that the UK government set certain standards that each airport has to meet. Before we bought it, Gatwick routinely paid fines for not being able to meet the standards. So they paid something like £1 million a month in fines. Today, we get £500,000 a month from the government because we are exceeding the standards, okay? So we think we've made it much better. And here's the thing that's important. People will pay for quality service. What people will not pay for is bad service. And so I think that really is the key. It's not so much are people paying more, are they paying less? The question is, are they getting better service, and do they think they're getting service that is worth what they're paying for it? And that's really how we look at it.
Helpful, thank you.
You have painted a rather attractive picture of investing in infrastructure. Is there a practical way for the smaller individual investor to get into the game?
Well, the good news is the SBA is doing that on the behalf of of many of you. So that's good. No, it's very hard for individuals to invest. So a fund like ourselves, for example, we accept. We have institutional investors. We don't really have individual investors. But you may have put me onto the next bright idea. And I assure you, if we take advantage of it, I will not give you credit. I will. You will be one of the first people we call.
What grade would you give the U.S. of A, and in particular Florida, to adapting its infrastructure to accommodate to the increased capacity of the Panama Canal?
Oh, I think that's probably I think Florida is actually doing a better job than many to prepare for that day. But I don't think the U.S. has started to focus on the issue. I mean, Florida is doing a better job. I think Virginia is starting to do some things that are focused on it. But most of the rest of the country is not focused on that. And I think it is so. It reflects the overall problem that our infrastructure is simply poor. Okay? And and the impact it has on productivity and on sort of job creation is something that we don't measure. I mean, why should it be that if you want to ride a train that travels 120 miles an hour, you have to go to China, you have to go to Japan, or you have to go to France, and you can't do that in the U.S., that our rail system is still running on sort of archaic rails? Why should it be that our air traffic control system is still reliant on computers that were sort of from the 1960s? I mean, this is the 21st century. It is an issue that we have to face, and unfortunately, neither the federal, state, nor, quite frankly, local levels is there any clear signs that people are focused on this problem.
I have a question about chicken and egg, I guess. You talked a little bit about China versus India, and China is not a democracy. India is a democracy, and so there are big political issues, and of course that's part of the the problem in the United States.
True.
So how does India move toward more privatization and the benefits?
It's very simple. They have to get serious. I mean, the problem is I just don't think I don't.
But you have the politics.
Huh?
But you have the politics. So what is seriousness?
The government has to decide that this is something. I mean, it's not as if Australia is a democracy, right? Margaret Thatcher dragged the UK kicking and screaming through a whole series of privatization. She sold off everything the government could sell, right? So it can be done in democracies, but it requires a government that is, or leadership, I should say, that is determined and focused and creates the right environment for it. I mean, how did Margaret Thatcher sell privatization? Say, I'm going to make a capitalist out of everyone. So people were able to buy shares at, my wife is English, she was able to buy shares at, very low prices. You got to pay for it over 3 years. And, the prices went up. Of course, everybody fell in love with that. So, I mean, I think there are things that the governments can do if they're serious about it. I think India's problem is, it's a reflection of India, of a much bigger issue in India than just privatization.
Great talk. Do foreign governments set rate limits with the equivalent of, public service commissions that affect your activities? And the second question, what's the average turnover rate for your projects? You sound a bit like angel investors that come in and prove things and then turn
Sure.
over. Thank you.
Two very good questions. From all of our regulated businesses, there is the equivalent of the Public Service Commission, or however you want to call it. So, for example, at Gatwick Airport, We're currently, the regulatory cycle is every 5 years. And so as we speak, we are currently going through the latest iteration in the regulatory cycle, where the regulatory authorities will tell us what they think we should be able to charge. And of course, the whole process is all very interesting because the airlines all come in and say, well, they shouldn't be able to charge us anything. And the consumer will come in and say, well, we think they should cut their prices. And then the regulator comes up with a number, and then we argue, and then we sort of compromise. And so there is a process like that in most regulated companies. In terms of the time frame for our investments, our fund has a life of 10 years. So for GIP1, which we closed in 2008, by 2018, we need to have sold and returned capital to our investors, or we can extend it for a few years, but realistically 2018 is the life. So when we make investments, our view is we expect to hold them for somewhere between sort of 3 to 5 and 7 years, because you have to buy it, then you have to improve the nature of the operations, and then of course you have to be able to sell it at the point in time where the economic environment is attractive. So that's how we look at it, things. Okay.
Hi, and thank you for your talk. It's been very intriguing to me because I've been buying water and wastewater utility in Florida for the last 25 years.
We need to talk.
Yeah. I started out with the private sector,
Right.
and I've been working the last 13 years or so with the government.
Yes.
So I'm intrigued when I hear you talk about the very practical examples of how you save money.
Yeah.
Truly, it sounds like it's management expertise.
Exactly.
And we find that as well. There's a second thing, though, too, and I'm intrigued by, there is a difference in Florida in how our government utilities, even though in the water wastewater industry, the rates are typically much lower
Yep.
than the privately owned water wastewater. But what we find also is the treatment of expenses by governments. They expense everything, and as you know, that makes it tough to earn a return.
Sure.
The private utilities can come in, they're allowed to capitalize
Sure.
things. How much of that goes on where when you're able to buy some of these infrastructure items, how much is that is accounting treatment and the differences in the way you treat expenses? And how much of it is the managerial, like you mentioned those anecdotes, how much is that?
We find very little of it is accounting. Our view is the way to be successful in investing in this sector is not through accounting or financial engineering. So if you look at our companies, we actually typically don't have a lot of debt on them. So if you look at across all our portfolio, it's about 50% debt, 50% equity, which is low for infrastructure businesses. A number of our portfolio companies have no debt on them at all, okay? Because we think the best way to be successful is you have to buy right. If you overpay for any of these businesses, you'll never make a decent return. But more importantly, you really have to run them differently from the way they historically have been run. Think about it. If IBM decides they're going to look for a new CEO, do they go to some infrastructure business to find a new CEO, or do they go to some industrial company, right? Most of the talent is, in fact, in industrial companies. These companies are forced to compete every day, and that creates an approach to decision-making, an approach to running the business, where we think if you take that and you translate that into the infrastructure businesses, you will improve their efficiency. You will certainly improve the nature of your customer service. In fact, just as an anecdote, you remember the waste company I told you, the ones who didn't figure out how to bill their customers? Do you know what they call their clients? Debtors. That's what they call their clients, debtors. If you view your clients as debtors, are you really likely to treat them as customers or clients, or are you really more likely to treat them as so little things like that, I think we think make a huge difference.
Yeah, and I have to say my hat is off to you because you say all the things that we look for when we're actually going to buy somebody. And if they speak like you, we don't buy them because they're well run. So thank you.
Sounds like we should team up.
Thank you very much. Thank you, everyone. Meeting adjourned.
You've been listening to a delayed broadcast of the Economic Club of Florida luncheon meeting of May 24th, 2013. Join us again next time for another meeting of the Economic Club of Florida on WFSU-FM.